So in this video, this is Vivek Ramaswamy. He's basically worth about $1.8 billion based on last year, 2025's valuation in terms of net worth. And he basically has come to prominence in terms of everyone's eyes because he was the Republican nominee for the last elections, but he obviously died out towards the end. So he essentially has amassed a fortune in biotech. So he IPO'd one of his companies, and he done various spin-offs and exit strategies. So this is going to just give you some insightful information in terms of how he's actually acquired his wealth and understand the differentiations of various correlated, uncorrelated asset portfolios and what you should really be looking at along your investment journey.
There's always been the arguments of stocks versus real estate. And historically, stocks have always done better than real estate when you look at the long-term appreciation. And I've always said that when you look at the Forbes list, everyone on that list is essentially there because of their stock holdings, whether it's stock in their own company or stocks in other companies that they've invested in. So as a billionaire, and we talked about this last time, where you are financially, what percentage of your wealth is in stocks versus real estate?
Overwhelmingly high in stocks, but that's just because of how I ended up generating my wealth, which is through companies that I've founded, actually, where I founded, have been CEO or been in a core founder role that have ended up creating a lot of value. That ends up being disproportionately concentrated, and even a lot of the liquid wealth that I've had is also represented in diversified baskets of different kinds of securities that include stocks, and also once you're at a certain level of needing added diversification, then you look at other kinds of assets as well. So there's some real estate, I'm in a unique position where most people can actually see what that looks like because having run for US president, that's actually publicly disclosed. I also think one of the areas where you're going to see more.
So he touched on a very important area. 2/3, so 66% of multimillionaires in America have basically accumulated their wealth via their own business. So this isn't from real estate. This isn't from stocks and shares. This isn't from working for someone else. This is from actually starting a company, getting the company to profitability, generating revenue, and then having some form of valuation on their business or based on their cash flow that they're generating to that point. So it's quite interesting breakdown that how you see this, and some estimates actually suggest that the figure is actually as high as 85%. So like, for example, myself, I'm a multimillionaire. I accumulated my wealth through building a business from scratch from the start when it was nothing. So just based on the idea.
Conventional mainstream wealth management wisdom is to say that you want more uncorrelated assets in a portfolio. So you could have stocks, bonds, you could have different types of even newer assets. You could have uncorrelated assets or at least in the future could be uncorrelated assets like exposure to crypto, like exposure to Bitcoin. And I think one of the things you see even in that world, you're going to see an evolution as well. In the Bitcoin world and in the crypto world, you have kind of a maximalist philosophy where it's like, okay, because I like this and then I'm going to go all in. Right. And I'm never going to sell and I'm only going to be all in and put all of my assets there.
Right.
That ends up becoming a belief system. Versus where I think the world is actually going to go, which is one where you say, all right, there's portfolio theory that says you have diversified holdings of different types of securities. Where does crypto or Bitcoin fit in that? Should that be 100% of your portfolio? Almost certainly not. But could that be for the right person, 1 or 2 or 3% of your portfolio? But for tens of millions of Americans who haven't even thought about that in the past, I think that's going to be one of the developments we see over the next decade as well that I think is going to be pretty interesting.
And I think we're actually starting to see it now. And in terms of uncorrelated assets portfolios, essentially it's a strategy that more or less combines different assets whose performances are largely independent of each other. So I think one thing that you need to take in consideration, things such as crypto, for example, I'm invested in crypto. I have made a lot of money in crypto, but you have to stomach the volatility. So during crypto winter, the times when it's not going up, right? And there's periods of 1 to 2 years when that happens from this 4-year cycle, is that basically it can actually go down by literally 60, 70, 80, 90% drawdowns. So if you can't stomach that volatility, you shouldn't be involved within crypto per se. Then you've got real estate that generally generally grows in value over time, right? There's some tax incentives that you can also use. You have stocks, S&P 500, which is basically since 1926 has generated a compound annual growth of 9.8%, right? So you know that you're going to be getting 8-9% per year in, year out. There will be times such as the Great Depression where you get 20-30% massive drawdowns, but that's not occurring every year, right? It's occurring once in a decade, for example, or once every 20 years, so half a century. So these are things to take into consideration.
What percentage of your portfolio is crypto?
I got to do the math right now and look at my exact numbers, but it would be it's a small portion of the total portfolio is the answer.
1%?
And I would say it's probably ends up being less than that because my holdings are so concentrated in the equity of the companies that I have founded, and I tend to actually believe the most in the companies that I've founded, like most founders, and that's one way you actually really generate wealth is creating something of value that didn't exist and holding on to that all the way through the point where it actually appreciates. Even if you take some amounts, of liquidity along the way, as you see founders, do as companies go public and so on.
I think you also have to take in consideration if he has a valuation if he has a net worth of $1.8 billion and majority is still within those companies, let's just say 70%, 80% are within those companies, for example, he might have 100 million, 200 million that he's managed to sell, or for example, or he's taken a loan out on some of his stocks. Then you have to say, okay, he's probably bought real estate and so on and so forth. He probably has treasuries. But then if you invest into volatility, you have to say, what is the upside for that? So it's only going to be a token for him to invest in Bitcoin based on his views from a libertarian or a maximalist views, right? Based on having something that's peer-to-peer, that's cryptographic, that's permissionless. So their ideology rather than having 1% or 10% of his portfolio within crypto. Also, if when you take a look at uncorrelated assets, right now you're seeing this massive growth or pump in precious metals, right? So this is normally seen as an area for safe haven assets, but you're now seeing silver at $75, $76 an ounce. That's the highest it's been. You're seeing gold at above 4,000. That's the highest it's been. So if you're taking all these things in consideration, having a diversified, uncorrelated assets is extremely crucial in the current environment that we're in right now.
In general, the way you generate massive amounts of wealth at the highest level. You talk about Elon with Tesla. You talk about Bill Gates with Microsoft. It is creating something of value and allowing that equity value to compound and appreciate. And so that ends up being a little bit different than people who have made their money through, income through a high earning job that then invests that tends to look a lot more spread out than a guy like me who's been a founder.
Yeah, I've always said that there's no such thing as a middle class. There's just rich and poor. And the difference between those two is that rich people take a significant percentage of their earnings and then invest those earnings, and those earnings start to make money on their own and they compound over time. Poor people, regardless of how much they make per year, spend the money they make and live paycheck to paycheck. Now, someone making 150, 200,000 could be poor if they're living a lavish lifestyle and basically living on the edge. So my whole thing is that if you don't invest money and utilize compound interest, you're going to have to work until you die. Would you agree with that?
Yeah, I generally agree with that. I would also just add one more dimension because there's two kinds of rich people. And I think that this opens up for the people who are in the poor people bucket to actually be able to have a choice between these two other paths, right? The one kind of rich person is the hired rich person. I mean, these might be CEOs who are making tens of millions of dollars a year, but it's still a hired hand, a very expensive hired hand. Investment bankers, people work on Wall Street, et cetera. That's one type of rich person. There's the other type of rich person who's in the creator class, which is different than the managerial class. The creator class is somebody who creates equity value by creating something that does not exist in the world. And so I think that takes a lot less financial capital in general, but it takes more ideational capital.
Definitely agree with him. Obviously, less financial capital, but however, those that are working for WT, for example, working for an organization. You could be a CEO of a company, you could be a doctor, surgeon, nurse, a lawyer. To get to that point where you're earning $400,000 a year, $500,000, $600,000, you have had your training in terms of to be able to get to a point where you have then qualified, gone through the bar exams, or done medicine for 6, 7, 8 years, right? So you've gone through a long journey. Then once you get involved within the industry, then you'll get quite a quick ranching of that salary, right? However, but you're still working for that, yes? And that's the big difference. But I see as a description of what wealth is, for me, is that if I could live off, if my lifestyle, so all my expenses and everything I do in terms of lifestyle is literally covered from the passive income that's generated from my principal, then that's how I distinguish someone that is wealthy, right? So let's say, for example, you have $1 million and the stock market does 10%, and that 10%, you take out that 10%, you make 100 grand, right? That 100 grand, you can be able to live off, let's just say expenses of 50,000, 60,000 a year. So you're covering your expenses of 50,000, and then you got another 50,000 for you to be able to do whatever you want with it, right? For me, that is being wealthy. I don't believe wealthy is based on having $10 million, $100 million, $1 billion. I believe it's, can you live your life and everything that you want and have a phenomenal lifestyle, right? But you don't touch your principal investment. If you can get to that stage, then that's what I consider my consideration, a characterization of being wealthy.
And so I think there are a couple of different paths, and not everybody's cut out to be one of those things or the other. But I don't think it's just like one category of rich people. The people in the managerial class are very different than the people who are in the creator class. And I have kind of a unique experience of having lived in both of those worlds, or at least having had enough of a taste of all three categories, right? I grew up in Southwest Ohio as the kid of legal immigrants who came here with no money, legal immigrants, but no money or minimal money. Then I ended up getting a hired for salary job that ended up being, over time, a very high paying job, but it was still a salaried job where you're not the owner. You're not the person who has uncapped upside. You're the guy, if you do a good job, you get a paycheck that's bigger than I would have ever imagined growing up in Cincinnati, Ohio, but it's still a paycheck. And then you have the creator class of actually creating companies, which is what I've been doing in the later phase of my life before I entered politics. That's really was none of the amount of money that I earned over nearly a decade of being the high salaried worker in the hedge fund world. It pales in comparison. It's not, it's a lot of money, more than my parents ever would have imagined anyone in our family making. But it is a pittance compared to what you actually create by creating something that does not exist in the world and owning that equity value. And then there's the tax system that also actually rewards that latter form over the former form too, because that latter form, if you're getting a paycheck, even if it's
So if you take that into consideration, if you pull up, for example, a hedge fund manager, the average range is about 170,000 for entry roles, right? And this could really span up to maybe 300,000 for analysts, or it can actually increase up to 200 to 1 million for senior portfolio. So a senior portfolio hedge fund manager will make anywhere from 200,000 to $1 million a year, which let's say by all purposes that's considerable amount of money, right? However, if you build your own company and your company becomes successful, like his biotech firm, and then that company gets an IPO, then his net worth, the amount of money he's earning, his net worth is basically billions of dollars potentially. So it's uncapped. So this is the differentiation between a high salary job, which is fantastic. You still have to work, but then to having an idea, creating your own, utilizing innovation is uncapped. And that's where the money is. And that's the same thing what I done with my company. Started out, built from scratch, and then I saw the long-term future. First few years are very difficult because you're trying to find product market fit, trying to find the traction, understand the demographics that you're trying to serve. But once you start gaining traction and momentum, it overcomes anything you're going to earn from a high salary job.
Really big paycheck, you're paying taxes on that cash year to year, but equity value appreciates without being taxed year on year. That could change.
Yeah,
That could change if Kamala Harris becomes president, because one of the things she wants to do is to implement, and Bernie Sanders and Elizabeth Warren and a lot of Democrats, agree or not, you may agree or not with the policy, but they would say that those people in the creator class or the equity holding class should pay taxes every year on a portion of their equity value. But the problem is that then requires them to sell the shares in the companies they've created even before they otherwise want to sell, which would trigger a cycle of forced selling. That could actually cause a stock market crash.
Yeah.
So he basically is alluding now to what actually happened. So since this interview had took place, now what's happening is there's something called a billionaire tax. It's a California wealth tax proposal. So not throughout the whole of America, just specifically in California for now, where they're imposing a one-time tax of 5% on the total wealth of California tax residents who have a net worth more than $1 billion. So that's massive, right? So even that if your net worth is actually unrealized, which means you don't have $1 billion of liquid cash sitting in your bank account or in treasuries, for example, even if it's in your company and that's just based on evaluation, still they will hit you with that 5%. So he actually mentioned something also important, is that this could then start this can start activating where it could be a massive market crash, because then these companies will then need to start selling. And now we're starting to see a lot of the venture capitalists, a lot of owners of these big companies are now actually moving their residents from California. You've just had, obviously Elon Musk has left, right? David Sachs has basically left. Larry Page just acquired a mega mansion in Miami, right? So now a lot of these owners of these multinational corporations generating billions of dollars in revenue, they are now, or probably on the verge, Peter Thiel, right? Who was the founder of the PayPal. And he's behind Founders Fund. So he's basically set up an office in Miami now, right? So all of these things that needs to be aware of. So if you like this type of information, we talk about investments, money, budgeting, tax, savings. We're also going to be adding an investment spreadsheet in the description very soon. And also for Patreon, if you like what we're doing, please like, subscribe and follow, and also to support us if you can. So thank you.